Good afternoon, everyone. Welcome to the 2025 Capstone Conference hosted by University of California, San Diego, Reddy School of Management, and the Master of Professional Accountancy program MPAc. I'm Professor Menes Tingekum, joined by my colleague Jim Dioid, Executive Director of the MPAc program. We're also joined by exceptional TAs, Stacey Kang and Tila Ula, whose leadership and support have been instrumental throughout this capstone experience. Today, you're going to hear boardroom-ready insights from a remarkable group of graduate students, the product of rigorous research and focused preparation. This year's theme is investing in the future, building resilient and sustainable growth, highlighting how boards navigate strategy, oversight, and innovation in an increasingly complex world. Student panel are tackling topics such as AI M&A, ESG assurance, blockchain governance, audit ethics, and many more, all grounded in SEC and PCOB guidance with real-world takeaways for boardrooms and leadership teams. Very grateful for our key supporters and partners, including Deloitte, Apple, PwC, EY, KPMG, Moss Adams, RSM, BDO, and many more, whose partnership helps power this program and inspire the next generation of leaders and professionals. Now close your tabs, put on your best headphones, and join us in celebrating learning, leadership, and the future of the profession. Welcome to the 2025 Capstone Conference. Let's begin. Today's session will be on Over the Ledger, Navigating Ethics in a Digital-First Accounting World. In the press, there's a lot of conversation around the recent PCOB release on the final guidance on QC 1000, mandating that accounting firms adopt firm-wide quality controls addressing digital tools, AI, and ethical risk. A shift in how boards must oversee accounting practices in tech-enabled environments. Today's panel is going to address how digital transformation is reshaping accountants' ethical responsibilities. And the topic we're going to cover include AI in tax planning, ESG-related fraud risk, evolving PCOB expectations, and the emerging role of ethics officer and cross-functional governance. The team is proposing practical ethical guardrails and offer question boards should be asking today. I'm delighted to welcome Tony to our virtual stage at the Reddy School of Management. Tony and the team will close out our capstone with his forward-looking and value-driven session. Very excited for the conversation. Tony, the stage is yours.
Thank you, and welcome you all to our Capstone Project presentation. Before we start our presentation, we would like to express our sincere gratitude to Professor Menes and Director James for the unique support provided. To the Professor William Malloy for the concepts regarding the internal control financial reporting and the deep analysis in the current issues in the practice and the regulation of auditing. For the Professor Wade for the concepts regarding the ethics in accounting and business. To Professor Mark with the concepts related to the global tax and the business strategy. To Dr. Thu with the methods to do the professional research and to do the communication. And every single professor, lecturer, coach, faculty staff, and our great colleagues of this great program and this great faculty. You are the very foundation of our Capstone project. Thank you so much for all the unique contribution. Now, let's formally begin our presentation, Over the Ledger, which means we're going to talk about the things beyond the book, beyond those statements. What is beyond those papers? Spirit. That is what we focus on. We focus on both ethics, the spiritual core of the accounting profession, and digital tools, one of the hottest topics of the day, as our main points of discussion. It sounds like a too broad topic for us to dive into. So how are we going to do this? How are we going to discuss this topic in depth and in detail? First, we're going to start with our background and framing. We're going to introduce the very principal ideas of the whole digital accounting world. And then we're going to dive into the related legal and regulatory framework related to this area. After that, we're going to do some deep analysis with our real world examples. It's all about like several fascinating storytellings in this section. And then in the fourth part, we're going to dive into one very specific area, which is ESG and reputation risks. And to sum up, we're going to provide like several very practical governance tools and recommendations. So that is the whole structure of our presentation, of our Capstone project. For our panel, and this is Tony, it is my great pleasure to contribute to this Capstone project and to join this magnificent journey as a conference speaker and team creative leader of our team, with our team captain, Coco, our team project manager and secretary, Ethan, our team research analyst, Shunyi, and our team logistics and technology specialist, Bowen, with the team social media specialist, Ru Yan. So to do a brief introduction of our panel, for Coco, she is so interested in transfer pricing, tax planning, and compliance ethical issues. For Bowen, he is so enthusiastic about criminal in accounting. For Ethan, he shows great passion in accounting information systems, managerial accounting, and tax accounting. And for me, I'm so interested in M&A, SPE, and VIE. For Shunyi, she has a great passion in fraud detection, digital transformation, and audit process. And for Ru Yan, she is so passionate in the financial fraud and internal audit. Based on our interests, so we come up with this big idea, this huge combination of almost all the areas, the very basement of the accounting world, ethics. So now I'm gonna spare my time to Ethan to talk about the very first concept of our presentation, AI, audit, and accountability, to answer number one core question: what's the boards need to know? So now let's welcome Ethan.
Thank you, Tony. Good afternoon, everyone, and welcome. I'm Ethan Hilario, and I'll be opening today's panel by grounding the ethical challenge we're tackling and outlining the board's role in solving it. There's a fundamental shift happening right now in accounting, and it's not just about automation. Accounting decisions are no longer solely made by people using systems anymore. They're being shaped by the systems themselves, from how journal entries are flagged, to how ESG metrics are calculated, to how audit evidence is generated. We are embedding AI into the very core of our accounting infrastructure. That shift from human oversight to algorithmic action forces us to rethink two foundational concepts: trust and control. Trust in particular is emerging as one of the biggest barriers to AI adoption, not just for consumers, but for organizations themselves. Recent research from Deloitte shows that even among US consumers, concerns about data privacy, misuse, and loss of human connection still limit engagement with generative AI. And while 80% are open to AI in theory, adoption still depends heavily on transparency, clarity, and perceived reliability. If an AI system is making the call on whether a number is materially misstated or whether a report meets assurance and compliance standards, how do we as future accountants, auditors, or board members make sure that system is right? That is the question we're putting on the table today. And that's why our panel is called Over the Ledger: Navigating Ethics in a Digital-First Accounting World. We're not just talking about tools, we're talking about accountability, assurance, and the governance structures that are supposed to protect stakeholder trust in the financial system. Next slide, please. To provide some background, boards today are facing a dual reality. On one hand, AI offers real upside, faster insights, scalable audit procedures, and smarter financial reporting. It's growing fast. In finance, Gen AI adoption is growing at over 50% annually. The Gen AI market is forecasted to hit 1.3 trillion by 2032. And according to KPMG, 70% of CFOs say they are already piloting AI in financial reporting. But as AI adoption accelerates, ethical and oversight risks are rising just as fast. Let's talk about what that looks like. 1 in 3 finance leaders say they've received AI-generated outputs they cannot verify. That's not at risk. In 2024, a $120 million restatement was traced back to AI-generated audit evidence that lacked sufficient support, and Deloitte found that ESG reports created with AI are 3 times more likely to omit key risks. So, what does that mean for the board? If AI is being used to build those numbers, then boards are the ones who are ultimately accountable for the reliability of those numbers, even if they didn't understand the AI or the logic behind them. And let's be honest, in many cases, the governance has not caught up. But here's the flip side of that reality. AI is still an opportunity. It's accelerating organizational risk-taking, but it also gives boards a moment to elevate how they oversee accounting systems and ethical risk. And that brings me to the graphic that I've included here on the right. I selected this chart because it captures what executives and audit professionals are already worried about: bias, transparency, data privacy, explainability, and reliability. These are the pressure points where accountability starts to blur in AI-driven accounting. But what makes this graphic even more powerful is what's not shown. There's no bar for board accountability, no column for governance readiness, no clear owner when these risks materialize in financial reporting or ESG disclosures. That gap, the space between the systems, what the systems can do and who is responsible for the outcomes, is exactly what we're here to talk about today. Boards can no longer just ask, what tools are we using? They need to ask what controls, oversight, and ethical protections are in place around those tools. Next slide, please. So, where does that leave the board? It starts with asking the right questions. What should boards be asking right now to lead ethically and responsibly in this digital-first accounting world? Our panel is built around 5 questions that every board leader should be asking in this new environment. First, how are regulators like the PCAOB redefining audit quality in the age of AI? Shoni will break that down, showing how QC 1000 represents a meaningful step in that ongoing journey, anchored in risk management, sound governance, and a renewed commitment to public trust. Second, what can go wrong when ethical oversight doesn't keep pace with innovation? Tony will dive deep into real-world examples of how governance gaps have already led to restatements, audit failures, and accountability breakdowns. Third, how do ESG risks and digital reporting tools impact reputation? Coco will explore how AI-driven ESG disclosures can create blind spots and why boards must protect credibility, not just compliance. Fourth, what tools or frameworks can boards use to manage AI and automation responsibly? Ruyan will walk through actionable governance tools that make ethical oversight real, from checklists to cross-functional review models. And finally, fifth, how can directors lead with ethics in a world of constant digital change? Bowen will close us out with a forward-looking view on what ethical leadership needs to look like as automation moves deeper into accounting. To all board members at every company, consider this your roadmap for ethical leadership in a digital-first, AI-driven accounting world. Now, to kick things off, I'll now pass it to Shunyi to walk us through the regulatory side of the conversation.
Thank you, Ethan. Now through the background, we noticed that AI transforms financial reporting. Traditional oversight approach falls short. Fortunately, we have framework to guide us. Let's take a look at the QC 1000 and PCAOB's oversight. Next slide. First, PCAOB envisions AI transforming auditing mainly in 3 ways: automating tedious tasks, detecting fraud more efficiently, and dynamically adjusting risk assessments. However, to protect investor interest, boards must ensure that AI model remains objective, auditable, and transparent, with human oversight at every stage. Next slide. Under the guidance of PCAOB, what should boards do? They no longer passive observers in auditing evolution, but must actively govern how AI tools are integrated. Overseeing emerging risks like cybersecurity and update talent strategies to build a workforce blending technical AI literacy with critical accounting judgments. And in the next slide, this timeline illustrates the evolution of quality control standards leading to QC 1000, highlighting how accounting oversight has transformed in response to technological change. In the past, quality control relied on static manual reviews with paper-based documentation. As digital tools emerged, firms added electronic worksheets and basic automation. but these were often layered onto existing framework rather than integrated. Q7000 represents a fundamental shift, moving from periodic compliance checks to a continuous risk-based approach designed specifically for digital accounting environments. The standards effective December 15, 2025 recognize that AI and automation requires dynamic monitoring systems that can adapt to emerging risks in real time. And in the next slide, let's take a deep dive into Q7000. What is it? Q7000 is a voluntary global quality control framework for ESG reporting, providing ethics-driven standards that are gaining widespread respect in insurance practice. It focuses on materiality, inclusivity, and responsiveness, while enhancing credibility through independent third-party verification. This framework represents a significant advancement in standardizing quality control for ESG reporting across industries and borders. Later, my colleague Coco will mention how the Q7000 integrates with ESG. And in the next slide, the diagram illustrates how Q7000 components interact in a digital environment. Unlike previous standards that treated quality control elements as separate domains, Q7000 creates an interconnected system with monitoring and remediations at its core. The risk assessment process drives the entire systems, with continuous feedback loops connecting all components. In the digital accounting environment, these connections are critical. For example, new audit tools directly impact engagement performance and require specific ethics and independence consideration. The diagram shows how digital integration enables real-time information flows between components. This integrated approach is essential for managing the complex, interconnected risk of digital accounting systems, where traditional solid controls would leave significant gaps. And in the next slide, the metrics have also visualized how Q7000 requires different levels of board oversight based on technology risk profiles. The horizontal axis represents risk levels based on technology complexity, while the vertical axis shows current oversight intensity. The upper right quadrant deserves immediate attention. High-risk technologies lack insufficient oversight. These include automated decision systems and third-party tech resources, where Q7000 demands expanded board visibility and control. The upper left quadrant includes high-risk technologies already receiving appropriate oversight, such as AI-generated audit evidence and algorithmic risk assessment, where Q7000 requires continued intensive validation and monitoring. This metrics approach allows boards to strategically allocate oversight where it is most needed and document their risk-based decisions as required by Q7000. As technology evolve and mature, their position within these metrics will shift, require continual reassessment. And last slide, the PCAOB emphasizes responsible AI governance, requiring boards to lead by setting ethical standards, endorsing regulatory modernization, supporting public-private collaboration, and closely monitoring both innovation and risk arising from generative AI tools. Now let's invite Tony, who will bring this concept to life by examining several compelling case studies.
Thank you so much, Chunyi, for your wonderful discussion on the principles. So I just want to stay on these slides for a little bit while. I'm going to answer several questions here. Why do we need to update the QC1000? As we all know, and also as Chunyi introduced, the very latest version of the QC1000 is going to be effective at the very end of this year. And why do we need the regulation? Why does the PCAOB focus on those 4 points here? And because digital tools are not that reliable. There are quite a few risks related to it. How could we be aware of that? Knowing what the real world looks like is one of the best ways. Why do the boards need to take action? Learning from real-world examples and cases could answer this question. When it comes to tech and ethics, it's not just theory. real companies are facing real fallout. Walking through several cases that expose where digital accounting tools failed and what the failure cost is helpful and insightful. Most importantly, we're gonna answer the core question number 3 here in this section, which is how can boards step in before history repeats itself? All in all, failing to prepare is preparing to fail. Diving into these cases and examples prepares the board for those potential challenges and exiting risks. So here I'm going to sum up from the questions raised by Ethan at the very first beginning of our presentation. That from the board's view, the very first question is that what can the AI and digital tools help? That is to say, the board should know where the AI and digital tools could help, could provide support. The boards should gain a basic understanding of these tools. The Coco will later mention a point literacy. That is wonderful. That's going to tell you that how the board can be educated and trained and controlled to understand the tech and related issues. So as a board member, the role of digital tools basically is to make like everybody's job much easier. That is the very basic rule of AI, but we cannot fully trust the AI. That is the issue. So in this case, we should definitely face several risks and challenges. And based on that, we need to figure out the way that the boards do and think about those controls changes. So the second question here is that what do boards think about controls changes and how do boards face this kind of shifts? As we all know, in the past, all the process, the auditing process, the internal control systems is all done by the humankind, done manually. But for now and the future, it's gonna changing into the outer century. The whole process is gonna be done automatically by the AI, by several like colorful digital tools. So that is the evolution from the manual to the auto. And what is the role of the boards? How can boards oversee and operate better? One core is that they should establish effective mechanisms to recommend the board to do them more efficiently. The foundation of these mechanisms is QC 1000. That is the reason why Shuyi mentioned it like quite a few times. That is the reason why we desire boards to learn from the real world. And the other cause could be that they should pay attention to who is in charge to find the person who is reliable, who is that accountable, and to pay attention to the accuracy of the data, the operating models in place, and review of the whole report. That's something like that. So to dive into this area, to dive into those real-world examples, I'm going to tell you about 8 points here. 4 of them is meaning about internal failures, which means that the failures raised happened inside the firms. And the other 4 points here is about the service providers failures. That is about that when the boards, when the firms, they want to engage with the public accounting firms, that what should they pay attention to? What should they focus on? So I'm going to do this one by one. The first internal failure I'm going to mention is that algorithm bias. The revenue forecasting has gone wrong. I mainly focus on 2 cases here. First is about it's a case in the retail industry, and the second case is related to the financial services. So in 2023, a retail company raised its earnings after relying on an AI tool that used outdated data models, and pre-pandemic seasonal patterns were hard-coded, leading to inflated projections. And analysts raised concerns. The CFO initially trusted the algorithm's black box. And for the case in the financial service industries, it's like more and more financial institutions increasingly rely on AI for revenue forecasting. However, studies have shown that the algorithm bias can lead to skewed forecasts, impacting financial decisions. For instance, a report by Finastra highlights how biases in AI models can adversely affect financial services and leading to potential misstatements in revenue projections. So what kind of insights we could gain from those two cases? The very first point is that the board should definitely question the data inputs and all the model assumptions. And this should also tie better to the QC 1000 requirements for the risk assessments around tech use. And finally, they're going to regularly audit for biases and maintaining quality control in the whole audit process. And it's all tied to the QC 1000's requirements and standards. And the number two is about the over-delegation and greenwashing race. That is the area related to the ESG. So the case is that multiple S&P 500 firms in 2022 overstated sustainability metrics, and they relied on ESG software pulling third-party data, much of it are unverifiable. And investors flagged inconsistencies, and some assurance providers refused to sign off. Like, the ESG nowadays is increasingly tied to investor value, but the greenwashing damages that kind of trust. The QC 1000 speaks directly to monitoring and remediation of systems, especially when assurance is outsourced or automated. This is a wake-up call. So for the board, this case highlights the importance of boards' oversight in ESG reporting, ensuring that automated systems do not compromise the integrity of disclosures in line with QC 1000 focus on ethics standards. That is the reason why the Coco will later mention much deeper in this area to talk about several very specific failures in this area related to ESG. And internal failure number 3, that is about missed anomalies. Well, you know what? In 2021, the PCAOB inspection showed that a major audit firm used AI to automate anomaly detection, and which is lacked controls to audit that the AI's logic passed, where missed material misstatements in client files, and PCAOB flagged this as the deficiencies in tech governance. How could this be connected to QC 1000? QC 1000 required that there should be direct alignment with QC 1000 design and implementation criteria, that systems must be auditable and understandable. And this also the QC 1000 also highlights the need for real-time remediation protocols per QC 1000 section number 21. And here's the irony. An AI model meant to enhance audit quality actually weakened it because no one checked the checker. That is why I mentioned that one of the calls here is to find an accountable person, to find the right person who is going to be in charge. That is how the humankind matters. And the boards must ensure that AI tools in auditing are complemented with robust controls and human oversight, adhering to QC 1000's requirements for quality and reliability in audit engagements. So that is about the internal failure number 3. And the fourth internal failure is about over-reliance and no review. And that is a very, very common issue in the startups. A high-growth startup in the year 2024 used AI to out-categorize expenses. The capital versus operating expenses were misclassified, affecting earnings. And board was unaware it had approved financials based on audited AI logic. So that for the boards, what is usually happening for the startups? There is no AI governance committee, there is no ethical checklist prior to tech rollout. The QC 1000 requires firms to ensure proper documentation of technology decisions and review processes. The tech saves time, but when it shortcuts control, the board's fiduciary role is on their line. So this scenario emphasizes the need for boards to oversee financial processes, ensuring that automation does not replace critical human judgment. That is also about the importance of human and in accordance with QC 1000 standards for quality control. So that is all about the internal failures. For the service providers' failures, the point number 1 is about high deficiencies rates and regulatory scrutiny which happened to the BDO USA. In the year 2024, the PCAOB found deficiencies in about 86% of its audits. And these deficiencies were attributed to weak internal controls, inadequate supervision, and over-reliance on automated tools without sufficient human oversight. The PCAOB's findings led to increased regulatory pressure and highlighted the need of robust quality control systems. This case underscores the critical importance of implementing comprehensive quality control measures as emphasized in the QC 1000 standard to ensure audit integrity and investor confidence. And the point number 2 here is about the surge in client financial restatements. That is a case regarding EY. EY experienced a notable increase in the number of its clients restating financial statements in the year 2024. The third was linked to the firm's integration of AI-driven audit tools, which, while enhancing efficiency, introduced algorithm biases and over-delegation of judgment. These are all the points that I mentioned before, which is very common in the inside the firms. And these issues led to material misstatements and eroded stakeholder trust. For the board, this EY case illustrates the necessity for boards to critically assess the deployment of AI in auditing processes, ensuring the technological advancements do not compromise audit ethical standards and financial accuracy. And the point number 3 here is about audit documentation failures. A CPA firm, SKP, faced enforcement actions from the PCAOB after it was discovered that the firm failed to prevent or detect improper alterations of audit work papers. The firm's quality control lacks adequate monitoring mechanisms. That is the importance of the effective mechanisms, which I mentioned before, leading to violations of PCAOB standards and subsequent penalties. For the board, this case highlights the imperative for firms to establish stringent documentation and monitoring protocols, as outlined in QC 1000, to uphold audit quality and regulatory compliance. The fourth point here is about the supervision and review violations. The PCAOB section James Pai CPA firm and its partner for significant audit failures, including inadequate supervision and review processes. These lapses were indicative of broader quality control deficiencies within the firm, emphasizing the need of robust oversight and mechanisms. For the board, this enforcement action against James Pai CPA firm serves as a cautionary tale for boards to ensure that firms maintain effective supervision and review systems to detect and prevent audit deficiencies. So these are all the 4 stories I want to share in these sections. What am I going to do next is we drafted a risk heat map here that based on the very famous published journals, the databases, the consulting reports from the Deloitte, EY, and the organizations like the NASCD, something like that. And the map here that basically shows you 3 things. That what is the risk impact from the low to the high, and what's the risk likelihood, which means that how likely that this very specific type of risk could happen when you use the digital tools. And the size of every circle you could say in this map is going to show you the effectiveness of every single type of risks. So for example, as you can see at the very top right of this map is about the algorithm bias, which is very, very likely to happen when you use digital tools, and which could lead to very, very high impact if the algorithm bias happens when you use these kinds of digital tools. And the effectiveness of this risk is going to be so huge. So this is what this map want to show you, want to display it to the board. So let's do several breakdowns here. So first, I'm going to focus on the priority, meaning focus on the critical side. There are going to be like 3 items we should pay attention to. The first is about the algorithm bias, which directly linked to the QC1000's quality control requirements and SEC AI guidelines. And the second critical point here is about weak internal controls. That is to say that a firm has very inadequate systems failing to detect or prevent errors and fraud. That is related to QC1000's mandates. And the third critical issue here is supervision failures, which means the lackness of effective oversight of audit process and personnel. That is related to the PCAOB enforcement actions. And for the high priority issues, there are also 3 items. The first is about over-delegation to AI, which means the excessive reliance on automated systems without adequate human oversight. That is connected with the PCAOB inspection reports. And the second item is about the ESG reporting accuracies, which means the misstatements in environmental, social, and governance disclosures. And the third item here is about the over-delegation in ESG reporting automation. That mentions the risk of greenwashing through the automated disclosures. And that is related to the QC1000's ethical standards. And the last 2 moderate items here are the misclassification in automated expense and other classifications, which are all mentioned before when I introduced the cases and examples, those 8 stories. And the last point here is the inadequate documentation, the poor record keeping leading to regulatory non-compliance. That is related to the PCAOB AS 1215. So those are 3 breakdowns of that risk heat map. To do a little summary here, there are 4 key observations from those 8 stories and from the whole risk heat map. The first one is about the board should do some integrate ethical oversight, and those are the answers to the 2 stories I mentioned before, which are the internal failures and the service providers failures. Are the cases provided before. This could be the solution, could be the answer. And the number 2 observation here is about to strengthen the quality control systems. And this observation could answer 2 things, 2 issues. The internal also is about the internal failures and the service provider failures. Specifically, to strengthen quality control systems could deal with the misanalyzed and over-reliance and no review. And to strengthen quality control systems could deal with the weak internal controls and inadequate supervision and over-reliance on automated tools in the area of service providers, in those kinds of engagements, in those kinds of work. And the third observation here is that the board should enhance supervision and documentation. That is the answer to the misanalysis and over-reliance and no review. That is also the solution to the audit documentation failures, which is common, which happened in one of the service providers. And the fourth observation here is about that the board should monitor ESG reporting, and that could deal with the greenwashing risks, one of the internal failures. And to dive into this area, I'm going to raise by one question. And you could think about that your organization's tech stacks. Is anyone reviewing your AI's audit logics? And who owns the ESG platform's data inputs? If you don't know, that's your risk right there. So to dive deeply in this area related to ESG, I'm going to welcome the Coco to talk about several very specific issues and answer the core question number 4. How do ethics, ESG reporting, and tech governance intersect? Let's welcome Coco.
Thank you so much, Tony. Next slide, please. So, as my teammate Tony talked about accounting failures due to technology, weak controls, and AI bias, I'm going to go into more details about AI bias and how it can affect the accuracy and integrity of the company's ESG report. So, as organizations adopt AI and automation to streamline their operations and sustainability reporting, we are seeing a sharp increase in both opportunity and risk. So, on one hand, technology can make ESG reporting faster and more data-driven. But on the other hand, without ethical oversight, it can introduce blind spots, especially through AI bias and lack of transparency. And this intersection where we have ethics, ESG, and tech governance meet is where the board plays a crucial leadership role. Next slide, please. So here is a hypothetical situation based on real-world conditions. So a multinational firm, they use AI to automate carbon tracking for its ESG report. For those who don't know, there are basically three scopes of emission that will go into ESG report. We have scope 1, 2, and 3. So scope 1 would be more of direct type. So those are more company-owned operations, so they're easier to track. And scope 2, they're more of indirect energy. These can be purchased electricity or heating or cooling. And then scope 3, this is even more indirect. It goes through the entire value chain. It includes suppliers, customers, and logistics, and etc. So you can see, if in this case, the AI system, they exclude the scope 3 emissions because they had incomplete training data. Now the firm reported itself as carbon neutral, which will later be revealed to be inaccurate. So what would the fallout be? Honestly, there's a lot. So we could have investor backlash, reputational harm, and regulatory scrutiny. So this example just shows how AI bias, even when it's unintentional, can still compromise the integrity of ESG disclosures. So what exactly is AI bias in this context? It happens when AI models are trained on data that's not diverse or not representative enough, which can lead to systematic errors. In ESG reporting, this might mean underestimating emissions, excluding key environmental risks, or misclassifying the materiality of an issue. So bias can also creep in when AI is optimized for efficiency rather than in integrity. For example, a system may favor easier to calculate scope 1 and 2 emissions while ignoring scope 3. This will lead to ESG reports that look good on paper, but it doesn't reflect the true sustainability performance of the company. Next slide, please. So this is where the governance comes in. The board must ensure that ethical AI principles are in place, things like transparency, fairness, literacy, like explainability. It's also essential to demand regular AI risk audits, ideally assurance from third parties who understand both ESG and digital risks. Next slide, please. So as my teammate Srini talked about QC 1000, here, standards like QC 1000 can guide this process. Even though it's not mandatory, they offer frameworks to enhance trust, especially when AI-derived ESG metrics are involved. So to wrap up, when AI is used in ESG reporting, it amplifies both potential and risk. That's why ethical oversight and strong tech governance aren't just best practices. They're essential safeguards. It is up to the board to lead with both conscience and code. And now I'm gonna pass it on to my colleague Rian to talk more about governance tools.
Thank you, Coco. So I will continue with the governance tools and recommendation part. As technology transforms accounting and ESG practices, boards must shift from passive oversight to proactive governance. Ethical risks, biases, and automation errors are no longer theoretical. They are happening now. A structured ethic-first governance strategy is critical to managing these emerging risks and protecting stakeholder trust. Next slide. Boards should establish an ethical AI governance toolkit. This includes implementing AI risk audits to evaluate systems of biases and transparency, clearly mapping accountability across audit, IT, and ethics teams, mandating transparency reporting for AI tools, and holding regular tech ethics trail meetings to ensure that ethical oversight becomes a continuous practice. To meet evolving regulatory expectations, boards must align their policies with the PCAOB's QC 1000 standard effective December 2025. This means embedding continuous risk assessment, ensuring AI systems are adaptable and understandable, and placing special scrutiny on higher risk applications such as financial forecasting and ESG automation. Boards must recognize the growing risks in ESG reportings as automation expands. It should require independent assurance for AI-generated ESG disclosures, audit AI data source rigorously, and set ethical standards that prioritize genuine sustainability outcomes over superficial appearance. Next slide, please. As Coco had just mentioned, a real-world example shows the cost of governance failure. A multinational firm's AI tool excluded Scope 3 emissions, falsely claiming carbon neutrality. This led to investor backlash and regulatory investigation. ESG failures are not technical glitches. They are governance breakdowns that damage credibility. Next slide, please. Digital governance is fundamentally an ethical responsibility. Boards must require fairness, transparency, and explainability in every AI development. Human oversight must remain a critical decision point, particularly where AI outputs affect financial statements on public reporting. So, managing digital risks requires proactive, ethical leadership at the board level. By embedding structured oversight, aligning with QC 1000 standards, and leading with conscience and code, boards can protect the trust and build a resilient foundation for future growth. So let's move to the conclusion part.
Yeah, so let's begin with real quick with the conclusion. Next, please. Okay, so let's begin with the fundamental truth. Like, ethics is not optional. It's foundational. Like, especially today's digital accounting landscape. Like, as AI reshapes how we report and audit, we must ensure our ethical compass stays steady. And the QC 1000 framework offers a timely, like the latest and modern blueprint to safeguard our audit integrity and setting a standard for digital quality controls. And that's why we need the boards, like they need to actively undertake governance, and it's not just an IT issue. Like all the AI are based on human being, his leadership responsibilities. And lastly, we must remember like automation is not same as delegation. Like technology can support us, but it cannot replace human judgment. And our role as professionals is irreplaceable. Next, please. So how do we act on this? So first, boards need to establish clear AI governance policies, like ensuring every algorithm using financial reporting is true, is transparent, and is documented. And second, integrate the QC 1000 framework like directly into board oversight, and it helps identify high risk, low visibility areas. And third, and crucially, like mandate human judgment at critical decision points, like Tony has said about in his case example, like still need people to make the decisions between like the critical points and not replace human, not let the AI to replace human oversight. And fourth, we need to bring together all the ethics and teams, like cross-functional collaboration, which is called the tech ethics trait, like sure risk, biases, and the blind spots are properly addressed. And finally, we need to educate and empower board members. It's just like a daily routine jobs, and building AI literacy is essential for effective governance in this evolving area. And next, please. So our final points, I want to conclude in one sentence, which is being called ethical tech governance is not a reaction, it's a responsibility. Like we can't afford to wait until something goes wrong. We need to take all actions at the very first step. And ethical oversight of AI must be proactive, embedded into boardroom culture, and treated as a core accountability. Yeah, and thank you. That is all our presentation today.
Wonderful. Thank you so much, Wenbo and team. That was a great presentation on how to navigate ethics in a world driven by AI for the accounting world. So thank you so much for all the insights, for the wonderful work, for a lot of great principles that you also shared with the group. So thank you for the great work and for closing out this year Capstone conference. To all participants, so thank you for listening to the presentation. If you are interested to hear about this presentation, you can access the full session replay on the Ready YouTube channel. And if you are interested to have access to the materials, feel free to contact us. We are happy to share the materials that have been presented to you as well. So thank you again, team, for the wonderful insights, for the professionalism, for the articulation of the insights, for your leadership in really shaping the future of our profession. So thank you so much, and hope everyone has a wonderful day. It has been a great pleasure to host this Capstone conference. Thank you so much. Have a wonderful rest of your day.